Most people think the stock market is a place where mysterious men make mysterious decisions using words ordinary people were never meant to understand. They think it is a machine built for prediction, a place where the clever get rich by being faster than everyone else, a place where wealth belongs to the person who can guess tomorrow's headlines before breakfast. That is not how I have ever understood it. To me, the stock market only becomes simple once you stop looking at it as a parade of prices and start looking at it as a collection of businesses. That is the real divide. The person who sees only prices will always be nervous. The person who sees businesses has a chance to become calm, and calm matters a great deal in any game where time is one of the most powerful forces available. So I want to begin where almost all intelligent investing should begin. Not with a chart, not with a stock tip, not with what the Federal Reserve might do next month. I want to begin with a company. Because once you understand what a company actually is, most of the rest of the market stops looking mystical. A company is a basket of valuable things. That is the simplest way I know to say it. Some of the things in the basket are obvious: buildings, trucks, inventory, factories, cash, land, machines, computers, patents in some cases, pieces of the world you can point at and say there, that belongs to the business. Other things inside the basket are much harder to see and often much more important. A brand, a reputation, customer trust, distribution relationships, habit, a place in the mind of the buyer that causes him to choose one seller over another, even when the physical object itself may not be all that different. Those things matter enormously. Sometimes they matter more than the physical assets. The public often misses that because the public likes to count what can be touched. But value does not always sit where your hand can reach it. Think of a famous company people line up to buy from. Yes, they may have warehouses full of products. Yes, they may have trucks moving inventory and employees working inside large, expensive buildings. Fine, but if that were the whole story, competitors could copy the physical structure and earn similar economics. Often, they cannot. Why? Because the invisible things in the basket are doing the real heavy lifting. A name that people trust, a status association, a design reputation, a history of reliability, a habit of purchase so strong that the customer does not conduct the whole buying decision from scratch every time. That is part of the basket too. And until you understand that, you will never fully understand why one company earns extraordinary returns and another with similar visible assets earns very ordinary ones. That is why I say a company is a basket, not merely of stuff of economic power. Some of that power is concrete and easy to count. Some of it is psychological, cultural, or institutional and much harder to count, but no less real. Once you grasp that, the next question becomes obvious. Who owns the basket, and how does each kind of owner get paid? This is where finance begins for most people, although it is usually explained so badly that many intelligent adults spend decades feeling they are only half included in the subject. I have no interest in that sort of fog. A company needs capital. Sometimes the founder has enough. Very often he does not. So he must go looking for help. He can borrow or he can sell ownership. That is the first great fork in the road. Suppose a carpenter has skill and ambition but not enough money to build the operation he wants. He has saved $10,000. That is honorable, but it is not enough to buy the truck, the tools, the working inventory, and the cushion he needs. So he goes to a friend for more money. Now his friend has a choice. He can lend the money or he can invest it. Those two things are not the same. If he lends the money, he is saying, I want my principal back and I want interest for the use of my capital. That is a bondholder's position in substance. A bond is just a loan expressed in marketable form. The language gets fancier later. The reality stays plain. Give me money now. I promise to give it back later. While you wait, I pay you a fixed return. That has advantages. A lender stands earlier in line. He gets paid before the owners get what remains. He has less upside if the business becomes spectacular, but he has more defined rights if the business merely muddles through or needs to be liquidated. Now suppose instead the friend says, no, I do not want interest alone. I want part of the business. Then he becomes an owner. He is no longer entitled only to a fixed coupon and the return of principal. He now stands at the far end of the line, which can be dangerous, but he participates in the whole residue of value after promised claims are satisfied. If the business becomes a marvel, he enjoys the upside. If the business becomes a disappointment, he may lose much or everything. That is equity. It is residual ownership. That is why I have always thought the difference between debt and equity should be taught to children early. It clarifies much of the world. Debt says, pay me first, but only what was promised. Equity says, pay me last, but what is left may be very large. That is the deal. People like to complicate this. I prefer not to. The deal never really changes. A lender may look wise in a mediocre outcome. An owner may look brilliant in an extraordinary outcome. A lender sacrifices upside for priority. An owner sacrifices priority for upside. Once you understand that, a great deal of financial language becomes only decoration. Now let us continue with the carpenter. He borrows money, gets to work. And a year later, the business has become profitable. The truck still exists. The tools still exist. Perhaps new customers now know his name. Perhaps word of mouth is beginning to do some of the selling for him. That reputation belongs in the basket too. Now the profits appear. How are they divided? The lender gets his principal and his interest. No more, no less. If the carpenter earned $50,000, the lender does not suddenly become a partner merely because the year was good. He lent, he did not own. After paying the lender what was promised, what remains belongs to the owner. That is why stockholders can make far more in good outcomes. They are not paid a fixed amount. They own the leftover economics of success. But this cuts both ways. If the business fails, the owner can be wiped out entirely, while the lender may still recover something through whatever assets remain. That is why stock ownership is riskier. You are buying uncertainty in exchange for upside. And that is also why the phrase stocks for the long run is only useful if the stocks are claims on durable businesses bought at sensible prices or owned through a broad, sensible structure. Ownership is powerful. Blind ownership is not wisdom. Now suppose the carpenter's business thrives. He wants to expand. He could borrow more, but perhaps too much debt would make the operation fragile. So he sells pieces of the company to friends, to local investors, eventually perhaps to the public. This is where the story becomes especially important for ordinary people, because this is the point where many people stop thinking clearly about what the stock market actually is. When a company first sells stock to the public in a meaningful way, it raises capital for itself. The company gets the money, new owners get slices of the basket. That is the basic logic of an initial public offering. The business sells pieces of itself in order to fund growth, repay other obligations, create liquidity for early owners, or some combination of all three. Fine, but after that first sale, something changes. The company often stops being the person on the other side of most trades. If Maria bought shares from the company in the initial offering and a year later wants out, she usually sells those shares to another investor. That second investor pays Maria, not the company. This is one of the most important ideas for a beginner to understand, because otherwise he imagines every time he buys a stock he is funding the company. Usually he is not. Usually he is buying the slice from another owner who wants cash more than he wants the slice. That is the stock market, a giant transfer market for business ownership. People are constantly swapping claims on baskets. Some are getting out, some are getting in. The companies themselves stand behind the curtain, continuing to operate while ownership pieces pass from hand to hand. That is why I have never treated the stock market as a sacred oracle. It is a marketplace, useful, yes, very useful, but still a marketplace. Its greatest gift is not prophecy. Its greatest gift is quotation. It offers prices. That is why I say it is there to serve you, not to instruct you. A quoted price tells you what someone else will pay or accept. Now, it does not tell you by itself what the business is worth in any final sense. It only tells you what the crowd is doing at the margin. That difference matters, because if the market were always a perfect weighing machine, there would be no opportunity in it. The market is often emotional, often impatient, often euphoric, often afraid. That makes it valuable to the calm person who understands the basket better than he worships. The quote, "Why do prices move?" Again, the simplest answer is the right one. Supply and demand, more eager buyers than sellers, and the price rises, more eager sellers than buyers, and the price falls. But that only pushes the question one step further. Why do buyers and sellers become eager? Because they are forming judgments about the future. A business reports strong earnings, and the crowd revises its expectations upward. A new product looks promising, and the crowd imagines higher profits. A recession threatens, and the crowd imagines lower profits. Interest rates rise, and suddenly future cash flows are discounted more harshly. A regulation changes, a war begins, a rumor spreads, a chief executive leaves, a scandal appears, a competitor emerges, a tax law changes. The crowd is constantly trying to translate future possibility into present price. That is why stocks can be so volatile in the short run. The basket itself may not have changed much in a week, The public estimate of the basket's future power may have changed a lot. This distinction can save a person a great deal of mental pain. When the price of a stock you own falls sharply, the first thing many people feel is personal betrayal. They think something deep and objective must have happened because the quote changed. Sometimes something deep did happen. Sometimes the crowd merely changed mood. These are not the same thing. A serious owner must learn to separate the quote from the business and then determine whether the quote moved for a reason that permanently changes value or for a reason that merely changed feeling. That is not always easy. It is always necessary. Now, if you own a piece of the basket, how do you make money? The public knows the answer in fragments. I want it whole. There are two broad ways. First, someone later pays more for your slice than you paid. You bought ownership at one price and sold it at a higher one, capital gain. Second, the business sends some of its earnings to you while you continue owning the slice. Dividend, that is all. Some companies pay regular cash distributions because they generate more cash than they can use intelligently inside the business. Others retain nearly everything because they have attractive opportunities to reinvest at high rates. Neither choice is automatically good or bad. What matters is whether management is allocating capital intelligently. I have never been especially impressed by dividends for their own sake. A dividend can be wonderful if the company has surplus cash and limited high-return reinvestment opportunities. A dividend can also be a sign that management has run out of imagination or is catering to shareholders who want visible checks more than long-term value. Likewise, a company that retains everything may be doing the right thing if it can redeploy that capital at extraordinary rates inside a strong moat, or it may be hoarding and wasting it. So I ask the same question repeatedly: if I owned the whole business, would I prefer this dollar kept inside or returned to me? That is the owner question. Most public market conversation is far below that level. It treats dividends as prizes and non-dividend companies as somehow suspect, or it treats all retained earnings as automatically intelligent, because growth sounds exciting. Neither attitude is serious. Ownership is serious. Capital allocation is serious. Labels are just labels. Now we come to the part of the story where most people make their first large emotional mistake. They understand enough of the machinery to become dangerous to themselves. They say, "Good, now I know what a stock is, so let me go find the best one." This is where humility becomes more profitable than excitement, because the market is not empty, it is full of professionals, people with teams, models, access, screens, history, databases, and years of obsessive focus, and over long stretches after fees, many of them still fail to beat very simple broad benchmarks. That fact should stop the ordinary person in his tracks. It usually does not. Why? Because the ordinary person is not battling only mathematics. He is battling ego. He wants to believe he can beat the world at a game he has only recently begun to understand. Perhaps sometimes he can. Most do not, at least not consistently, and not after all costs are counted. Honestly, this is why I have told many people, and I mean this with complete sincerity, that if they do not intend to study businesses with unusual seriousness, and if they do not have the temperament to withstand their own emotions while doing so, then they should not make stock, picking the center of their financial life. They should own the broad machine. A broad low-cost index fund is one of the most useful inventions in modern finance because it allows a person to buy a basket of baskets. With one purchase, you can own small slices of hundreds of companies or even thousands depending on the fund. You do not need to decide whether one technology giant will beat another one, or whether one drug company will outperform another one, or whether one retailer will win the next decade. As competitive war, you own a broad collection of productive enterprise. This is not glamorous. That is part of its strength. The public likes glamorous things because glamorous things flatter the ego and create stories. Broad, low-cost ownership creates fewer good party stories. It creates better long-term results for many people. Consider what you are really doing when you buy something like a broad S&P 500 fund or a total U.S. stock market fund. You are not making a narrow prediction. You are not saying, "I know which one company will dominate the future." You are making a broader claim. You are saying that, taken together, American business will continue to adapt, grow, earn, fail, replace, and renew itself over time. That is a very different kind of bet. It is more humble. It is more diversified. And for ordinary people who are building wealth while also living real lives, it is often much wiser. Now let me say something that seems obvious and yet is ignored constantly. A broad index does not protect you from temporary decline. It protects you from unnecessary concentration. These are different things. The market can fall hard. Broad indexes can fall hard. They will again, if you own an index, you are not eliminating pain. You are eliminating the need to be right about which single basket will survive and thrive. That matters enormously. Individual companies can go to zero. Entire industries can become marginal. Dominant firms can decay. New firms replace them. Broad indexes adapt because they are rule-based collections of the major survivors. Weak companies leave, stronger companies enter. That is one reason broad ownership has served long-term investors so well. It is not static. It evolves with the economy. This evolutionary quality is one of the things people miss when they sneer at indexing as passive. It is passive in one sense. You are not manually selecting each company, but the structure itself is constantly adapting to real-world business success and failure. That is a powerful thing to own. Then there is cost. Cost looks small to the amateur eye and enormous to the long-term compounding eye. 1% a year does not sound like much. Over 30 years, it can eat an astonishing portion of future wealth. That is one reason I dislike unnecessary fees so much. Fees are friction, and friction compounds just as reliably as return does. The public spends extraordinary time looking for extra yield and too little time looking at what is quietly draining them every year. A low-cost index is attractive not because it is intellectually dazzling. It is attractive because it does not begin by handing part of your future to someone else in exchange for activity that may not even help you. You would be amazed how much better many households would do if they simply removed unnecessary costs, stopped trying to look sophisticated, and bought the broad machine. Now, having said all that, I know the next problem. The problem is not understanding the index. The problem is surviving your own emotions while owning it. Simple does not mean easy. A broad market fund will not make you feel brilliant every month. Sometimes it will make you feel foolish. Sometimes it will feel too slow in a bull market full of exciting stories. Sometimes it will feel terrifying in a bear market full of collapse talk. That is where temperament comes in. The person who buys the right structure and then abandons it every time the world gets loud has not really chosen the structure at all. He has chosen his emotions, and his emotions will usually sell lower than his reason would have sold. That is why patience matters so much. Compounding is not kind to the impatient. It withholds emotional gratification long enough to reveal who is built for it. The public loves stories of overnight success in markets. The market itself has created much more wealth through dull repetition than through brilliance. Buy, hold, add, ignore noise, reinvest. Wait, this sounds almost childish in its simplicity. And yet simplicity is one of the highest forms of financial maturity because simplicity is not ignorance. Simplicity is refusing to make an already difficult game harder than it needs to be. You can spend your whole life trying to predict the crowd's next mood. Or you can buy productive enterprise broadly and let decades do what decades have often done. I know which life I prefer. Now, if you are determined to buy individual companies, then at least do it with the seriousness ownership deserves. Do not buy a stock because the chart is exciting. Do not buy it because someone on the internet typed in capital letters. Do not buy it because the business is popular or because your barber likes it or because it sounds like the future. Ask the owner questions. If I own the whole business, what would I want to know? How strong is the moat? What are the returns on capital? How much debt sits above me? Does management act like stewards or salesmen? Can the business raise prices without losing its franchise? Does it need constant reinvestment just to maintain position? What am I paying relative to what I am getting? Those are the questions. Most people who say they are investing in single stocks are actually trading fragments of other people's excitement. That is not ownership. That is outsourcing judgment to the crowd while pretending it is conviction. I have never admired that much. The stock market is a beautiful device if you understand its actual function. It allows ownership to move. It allows businesses to raise capital initially. It allows later owners to exit and new owners to enter. It offers quotes every day. It lets patient people buy pieces of productive enterprise. It lets emotional people sell those pieces at unfortunate times. It is at once a mechanism of capital formation and a machine for exposing temperament. That is why I love it, not because it is exciting, because it is honest. Eventually, sooner or later, business reality matters. Sooner or later, earnings matter. Sooner or later, moats matter. Sooner or later, discipline matters. All the drama in between is merely the cost of admission for those unwilling to think in long stretches. So if you're just starting, I want you to remember a few things. A company is a basket of tangible and intangible value. Bonds and stocks are two ways of standing around that basket. One lends and gets fixed terms with priority. The other owns and gets residual value with risk. After the first major sale, most stock trading is simply owners swapping pieces with one another. Prices move because people are constantly repricing the future. You can make money through higher prices, through dividends, or through both. And if you do not intend to study specific businesses deeply enough to deserve concentrated confidence, then buying broad, low-cost indexes and waiting patiently is not settling for less. It is very often choosing wisdom over vanity. That is the distinction that matters. Most people lose money not because the stock market is impossible. They lose money because they never fully understood what they were buying. They bought symbols, they bought excitement, they bought noise, they bought urgency, they bought ego. Very few of them bought the basket in the sober owner sense. I would rather you begin there with the basket, with the ownership claim, with the difference between debt and equity, with the difference between buying from a company and buying from another investor, with the difference between a price and a business, with the difference between speculation and broad participation. Those few distinctions will take you much farther than most of the clever-sounding market chatter you will hear for the rest of your life. And once you understand them, the market gets quieter. Not easy. Quieter, that is enough. A quieter mind makes better long-term owners. Better long-term owners usually do better financially. That has been true for a very long time. I do not expect it to stop being true just because the apps got prettier.